How much do I need for a down payment?
Well, let's ask you, Celine. Celine, how much do you think we need for a down payment? I'm going to go right
You,
back at you.
you don't need 20%.
For
Everybody
sure.
thinks that it's 20%. Yes, it's great to have 20% down if you want to get rid of the PMI, but there are so many ways around that. In my experience, I've had so many clients have down payment assistance programs, use their VA benefits to have zero down, but usually it's anywhere between 3 and 5%.
You're right on. And I mean, some of the best programs are 3.5% down, up to 5% down. There's down payment assistance, like you mentioned, which is zero down, where you get the down payment from the state of Washington. And they provide it at a zero interest, zero payment lien against the property until you can refinance and get rid of it. It's a great program. And then VA, you mentioned, is zero down for our veterans and active military. And then you also have zero down USDA, which is the U.S. Department of Agriculture. It's more of a rural product, though. The properties have to be a little bit on the outskirts of the big cities, but still an option out there for very little down. And here's the thing, Celine, like 20% down is a big chunk of money. And to me, the beautiful thing about real estate that's really benefited me over the last 35 years of owning houses is the power of leverage. Like, I always believe that you put as little down as you can, leverage the power of real estate, and then watch it grow. The one thing that a lot of people forget about is real estate grows in two ways. Everyone thinks about the value going up, but there's also amortization that everyone forgets about. And that's every time you make a payment, the balance of your mortgage goes down, and that gets more and more dramatic over the years. So it's one of the few assets that you can leverage the heck out of it, not put a lot of money into, as little as zero down, like we've already been talking about, and watch the power of those two tools go to work for you without you having to do much of anything. Yes, you have to make a payment, but you have to make a rent payment. You got to pay rent somewhere. You got to have a roof over your head. So buying a house is one of the best investments I believe that everyone needs to take advantage of. And if you're concerned about how much you need to put down because I can't afford the payment, that kind of thing. I mean, again, for every 10,000 you put down in a house right now, you only save about $65 a month. The other part of leveraging is leverage that down payment. Like, oh, I have $30,000 for a down payment. Okay, well, what if we use down payment assistance, kept that $30,000 in the bank? Now what you could do is potentially use some of that 30,000 to supplement the higher mortgage payment and allow you to get into a house more comfortably, knowing you've got this huge financial blanket sitting over here that's going to protect you for a long time to come. And what I've found using that technique, and I've used it hundreds of times, if not more than that, over the 30 years of doing this, is a lot of those clients, I would say most of them end up not touching the 30 grand. They end up figuring out how to budget around this new payment that they have. And now all of a sudden their house is growing at this great clip, equity's going up, their balance is going down, and they have this money over here that's growing as well. And it just ends up being a great financial success story for a lot of the clients that do this. So if you're thinking about buying but don't have enough money down, or you're thinking about buying and you want to put more down because you want a lower payment, we should definitely talk about your situation and figure out ways where we can make it work. I mean, Celine, you're such a great negotiator on the housing side. A lot of times we negotiate with the seller to pay closing costs or buy down the rate. Have you seen that as much lately, or what's your thoughts on that?
Yeah, that's actually what I was going to suggest. With that extra money, can't they use, if they're using down payment assistance, can't they use the extra 30,000 to buy down the interest rate, or does that have to happen from the seller giving that credit?
Yeah, you can use it both ways. You can use your own money. I mean, they probably wouldn't be able to use all 30,000. There are some limitations on how much you can pay to buy the rate down from the buyer's standpoint. The seller has some limitations as well, but combined together, yeah, you could do massive buy downs. So we can have the seller pay the closing costs, so we don't need any money out of pocket. And we can also get even more potentially to pay down the interest rate as well, called a rate buy down or paying discount points to get a lower rate. That is by far the most effective way to lower your monthly payment, is to buy down the rate versus putting money down on the loan. But we always talk about those strategies when we find, we get people pre-approved, which again, get pre-approved, then we'll talk about, what the situations and options look like.
Absolutely. One thing that I wanted to mention that a lot of people are concerned about is that PMI, right? That private mortgage insurance. Can you tell us a little bit more about that?
That's great. I'm glad you brought that up. I almost forgot about it. Like, I love PMI. Like, so many people call me up and say, "Oh, I don't want to pay PMI." I'm like, "Why not?" Like, again, the power of real estate, in my opinion, this is my humble opinion, but it's worked out very well for me over the last 30 years, is that it's leveraging it. And PMI allows you to put 3% down or 3.5% down or 5% down or 10% down on a house. If it wasn't for PMI, you would have to put 20% down, and home ownership would be so much harder to reach. So I love PMI. I also love the fact that it's not that expensive. I mean, for someone that has really good credit, PMI can be very, very inexpensive tool in order to allow you to buy a house with very little down and not have too big of an impact on your payment. And I also think with the market that we're going into, the possibility of lower rates down the road are going to allow you refinance options. So that PMI is potentially going to be something that you're not going to have for very long either. After 2020 and 2021, many people were removing their mortgage insurance just after 2 or 3 years of owning.
That's what I remember. Two
Yeah, it's
years. It's
crazy.
wild. Yeah. Because, and what are the circumstances to get there?
It's required for the first 2 years on conventional.
Okay.
And then from year 2 to year 5, you need to show 25% equity in the house. And then after year 5, you need to show 20% equity in the house to remove the mortgage insurance.
Okay.
FHA is a little different. Their mortgage insurance is permanent for the life of the loan. So it only comes off after total amortization. The balance of the mortgage gets down to about 78% of the original purchase price, which that takes about 11 to 12 years. So another way to get rid of mortgage insurance on FHA, though, is to refinance eventually into a conventional loan that, has the removable mortgage insurance. So these are all strategies we work with all the time, and we'll definitely recommend different strategies based on your credit score, the amount down, and things like that as well.
Awesome. Thank you so much.